Hi, everyone. Welcome to Fundamentals Unfiltered. I'm Matt with the Fundamental Investing Institute. We are recording this on Tuesday, September 23rd, 2025. So in the news this past week, the Fed met on last Wednesday. That's September 17th, last Wednesday, September 17th. The Federal Open Market Committee voted in favor of a quarter point. That is 0.25%. So the target federal funds rate is now 4 to 4.25%. They always announce a target. 12 members of the FOMC, 11 of them voted in favor of the quarter point reduction. One of them, the economist Stephen Miran, who is on leave from the President's Council of Economic Advisors. He's serving out a term of a Fed governor that left a few months ago. He had voted in favor of a 0.5 point reduction with further aggressive reductions coming later in the year. He was the one outlier out of the 12 voting members. Remember, the FOMC is made up of the 7-member Board of Governors, 4 of the bank presidents that serve on a rotating basis, and the president of the New York Federal Reserve has a permanent seat on the FOMC. In fact, serves as the vice chair of the FOMC. It's a man right now named John Williams. So they're voting in favor of this quarter point reduction. This did have a positive impact on mortgage rates, according to bankrate.com. Mortgage rates were down to 6.27% as of Monday, September 22nd. This is down from a yearly high of 7.19% that it hit earlier in the year. Now, I did listen to an interview that Stephen Miran gave. I think he gave it on Friday. I was driving around and I had on XM Radio, CNBC, had him on, and even though he is asking for a much bigger rate cut than the other members, he actually sounded pretty conventional in terms of really respecting the Fed's price stability mandate. So I'm not too worried about it in terms of the president's so-called people being on the Fed. We have to remember that 2 of the FOMC members right now, even before Miran coming on board, Michelle Bowman, I think is her name, and also Christopher Waller, I believe. These are both Trump appointees. Christopher Waller, not that my opinion means anything, but he's probably my pick to be Fed chairman when Powell steps down in May. As we reported on a couple of weeks ago, the administration had announced that their top 3 candidates to lead the Fed are Waller, meaning Kevin Warsh, who is a former Fed governor, and he's someone who's been on a think tank for a while, and the other is Kevin Hassett. Kevin Hassett is now, I believe, at the National Economics Council. They're all pretty conventional picks. I don't see anything. I think the president is just going to continue to put out his opinion on things, and hopefully Fed independence remains. I'm going to get to things in a few minutes about the dollar and gold prices. But the Wall Street Journal had a piece several days ago that I thought was interesting. I don't pay a lot of attention to interest rate futures markets. I mean, I'm not in the business of forecasting interest rates, but I think it's good to take a glance at this every now and then. So one thing that the Federal Reserve Board of Governors puts out is called a summary of economic projections. And in that summary of economic projections, they put out what's called the Fed's dot plot. What this is the 7 board governors essentially submit their forecast for the federal funds rate, and they plot it on a chart and that's called the Fed's dot plot. According to the Fed's dot plot, the median projection at the end of 2026 is 3.4%. So this is the center number of those 7 projections at the end of 2026. This is where they believe the federal funds rate would be. Now, it's essentially an educated guess. Futures markets are betting that the federal funds rate at that same period will drop to a little under 3%. So this is the end of 2026. So that's interesting. Does it mean anything? Not really. There's a old saying that market forecasters exist to make tarot card readers look good. So we have to always take forecasts with a grain of salt. But I think the variance between the Fed's dot plot and the futures markets is interesting to point out. There's a market strategist named Ed Yardeni. He wrote an editorial in the Financial Times a few days ago that I think is worth highlighting. What Yardeni said is the Federal Reserve, of course, has a dual mandate. The dual mandate is price stability and maximum employment. And these two mandates very often come in conflict. What Yardeni pointed out is, the Federal Reserve is cutting because hiring is slowing. The labor market is slowing significantly. The question is, are the labor market issues cyclical or are they structural? The Federal Reserve, in expanding the supply of credit, which is what monetary policy is, it's expanding and contracting the supply of credit, they can only really address cyclical employment issues. If you have a lot of structural issues and you loosen monetary policy, that action could be very well inflationary. And as Yardeni points out, the Personal Consumption Expenditures Index, which is the Fed's favorite inflation gauge, is still running well above its 2% mandate. In fact, core PCE, which removes food and energy prices, does this because food and energy prices are very volatile. That's actually, I think in the latest month, was about 3%. So it's still quite a bit above the Fed's 2% inflation target. So on that basis alone, there's a lot of reason to question the Fed's actions and what this does to inflation and inflation expectations. As Yardeni points out, we have a lot of structural issues in the labor market right now. Labor supply has gone down both because of the immigration enforcement. It's also going down because a lot of people are just retiring, leaving the labor force. One of the issues is there's a lot of uncertainty. Some of it's policy driven, but a lot of it's AI. A lot of employers just don't know how AI is going to impact their businesses, so they're sort of holding off. When we have extreme uncertainty, that's what businesses generally do. And outside of the businesses that are investing very heavily in artificial intelligence, most mainstream businesses are pulling back on hiring and capital investment right now. So where Yardeni points out is, we seem to be in a position where the Fed is prioritizing employment at the expense of inflation. To some degree, that's where we were a few years ago. The answer, but one thing I will say is I hope students of all ages, high school, college, adult learners, are paying a lot of attention to what the Fed is doing right now, because usually we don't see the conflict in the Fed's dual mandate this explicit. So we're very much at a point where we are very explicitly seeing the conflict between price stability and unemployment. So we'll see. I was just paying attention to how this plays out. Personally, and I'm primarily an equity investor, I'm not modeling in lower rates. I use the 10-year as part of our cash flow models, our valuation models, and I don't feel real comfortable that the 10-year is going to come down significantly. It's hovering around 4%. I could be wrong. In fact, I guarantee you I will be wrong. I just don't know how much I'll be wrong. But I think inflation expectations could remain well above the Fed's 2% target for some time. Now, I want to draw your attention to something else that's sort of within this idea that monetary policy is still kind of loose, and certainly there's fiscal issues at hand too. I'm not ignoring that, but the dollar index measures the dollar against a basket of foreign currencies. It's down over 10% on the year, and of course we have, it's only September, we have months to go before year end, but this is the sharpest drop we've seen in several decades. You add to that the highs in gold prices, which have been hitting historical highs for weeks now. It's not a huge vote of confidence in the dollar, and it certainly doesn't point to too tight monetary policy. So I don't know, just something to keep in mind. I want to do a deep dive into an article that Barron's did on the red hot IPO market. See if I can find this article. But Barron's was pointing out that we have had the highest level of IPOs in several years. And of course, there's a lot of talk about whether this is a good thing or a bad thing for retail investors. On the surface, it shouldn't matter much. And the reason is most IPOs are allocated to institutions and ultra high net worth individuals that are favorite clients of the various brokerages that are underwriting the IPOs. Retail investors really don't get a slice of it. I'm not a big fan of IPOs for the reason that you're buying from the most knowledgeable people in the business. That's not who I want to buy from. I want to buy from people who are selling for institutional or behavioral reasons. So there's kind of an information asymmetry there. But IPOs can be very high profile and glamorous. There are a number of recent IPOs that have just popped. They're up multiples of their initial IPO price. Quite a bit haven't, of course. Now, one of the issues is the number of publicly traded stocks has declined quite a bit in the last 30 years. I think it's a little over 4,000. I think it peaked at almost 8,000 back in the late 90s. And speaking of the late 90s, I think to a lot of people, myself included, the IPO market feels a little bit like what we saw in the dot-com bubble era. That's when I first really got interested in stocks. But as the article points out in Barron's, because companies are staying private longer, you have a situation where it's good news and it's bad news for investors. The good news is companies are coming out more mature and they're already at profitability. If not, they're close to profitability. That was not the case in the 90s and early 2000s. Companies were going public very early in their life cycle. So there was a lot more risk. But the other side of that is investors could participate in the huge growth runway that companies would have. So, a lot of smart people are looking at things like the Google IPO from years ago and saying Google probably would not have gone public as early in its life cycle. Microsoft would probably not have gone public in as early in its life cycle as it would, as companies are now. OpenAI is a prime example of this. I think it just recently had a $600 billion valuation based on its most recent funding round. So, you know, companies are getting valuations in the hundreds of billions of dollars while still remaining private. That's really a change in market dynamics from what we saw 30 years ago. So private markets are just becoming, more and more mature. And now that private equity funds are going to be able to tap into 401k savings, I think private markets are going to become more aggressive still. But the fact that we are seeing more IPOs is good. I don't know if it's going to materially change the number of publicly traded stocks. As an individual investor, I'm always trying to keep a portfolio of 8 to 12 good names. And with the limited number of stocks available, it's true that there are less opportunities. One way to remedy that is to invest internationally, right? Invest in Europe, invest in Japan, invest in South Korea. These markets have had great opportunities over the last 15 to 20 years. So there's still plenty of opportunities for investors in public markets, but it is true that the number of stocks has declined. So hopefully this IPO trend, we see a little bit of a surge in public listings. I don't know what kind of regulatory changes we're going to see, because that was always one of the reasons for companies to either go private or stay private longer and not go into public markets. Being a publicly traded company is a huge regulatory burden. So I want to finalize this section because I came across an article. It was in my news feed from CNN.com. I thought it was really interesting. The world's off its rocker, but this is a silver lining. The article's titled, "People Are Assigning Themselves Homework for Fun." And this is such an interesting article. It was about, I guess, a lot of adults are creating their own self-study coursework. Variety of subjects: psychology, economics, sociology, whatever. And they're being very structured about this. I was interested because I've been an ardent adult learner since my early 20s. I own thousands of books. I will say the people profiled in this article are doing it in a much more structured way, so I'm kind of motivated to maybe do a little bit more planning in my own self-study. But I think this is a great trend. I guess this has taken off on a lot of different platforms, different social media platforms, where people are, sort of posting their plans, the books that they're going to read, the deadlines that they're given to themselves, the different assignments that they're giving to themselves. Because I think in some cases they're writing essays. But I thought this was great that people are actually spending a couple of hours a day in self-study. In most cases, reading physical books, which people don't seem to do much more. But I thought this was a great trend. I hope it continues. I hope it's not just a fad. Speaking of that, a book that I picked up over the weekend. I don't know if you guys can see this. It's called Primal Intelligence. I'm in the middle of reading it, down to the last few chapters, and I'm going to try to profile some books that I'm in the middle of reading. This book is written by a professor named Angus Fletcher. He works at Ohio State. Ohio State they have something called Project Narrative. I didn't know anything about this. I heard this author on an interview talking about this shortly before the book came out. The reason I was interested in it is he's talking a lot about natural intelligence, what he calls primal intelligence, as an anecdote to competing in an AI world. What drew me is he's working very intimately with U.S. Special Forces. And to me, any mode of thought or psychology that is embraced by the military and especially special forces fascinates me, simply because the context in which the men and women in uniform have to make decisions in combat scenarios. That's a much more intense environment than most of us will ever face. And so I've always been of the opinion that if it's combat tested, then it's worth considering to the extent that we can apply it in other contexts. But this project narrative at Ohio State focuses on something called narrative intelligence, which is essentially how people can use story to make decisions. And I'm still in the middle of this book. I'll provide a review when I'm done and I've had a chance to think about it. But I will say, so far, out of the thousands of books I've read, there are only a handful that have been real game changers for me in my own thinking. One of them is Annie Duke's Thinking in Bets. There are a handful of other ones, but I will say this book is becoming up there. Like I said, I need to finish it. I need to think about it. I need to go back and reread certain sections. But so far, it is really changing my thinking in terms of how we can tap into certain modes of psychology. You know, one of the things the author said that really resonates with me is that with traditional education, people are at risk of just becoming second-rate algorithms. We constantly have to think about what we can do, how we can facilitate our thinking in this AI world. So more to come later, but this is a book that is really changing my thinking and seemingly providing a lot of tools. And on the investment front, we're constantly looking for some kind of psychological edge, right? I mean, in public markets, you really can't have advantageous information, but you can use information advantageously. And I think serious investors always sort of go down this deep hole of studying psychology and trying to understand their own psychology, trying to understand market psychology. I think this is a book that can be a major contribution to that field, to the field of decision making in business and in finance and investments. So with that, hope everyone has a great week and best of luck in your investment endeavors. As always, focus on the fundamentals, filter out the noise, and we'll see everybody next week.